With more on what U.S. traders and markets are focusing on is Jill Maladrino, VOA Channels.
There's some anxiety in the market related to the timing and/or clarity regarding tax cuts, regulation reform, and border tax issues. In fact, on the overnight, we saw that we might get the repeal of Dodd-Frank, which is the financial regulation. Overall, the S&P 500 has lost steam after reaching a record close on January 25th. The question is, will market activity pick up after today's jobs report? Consensus sees 175,000 jobs added and the unemployment rate to hold at 4.7%. This is why we care about this report. The data gives us the most comprehensive report of how many people are looking for jobs, how many have them, what they're getting paid, and how many hours they are working. Wage growth is the key in this report. These numbers provide the best way to gauge the current state as well as the future direction of the U.S. economy.
Now, talking about the job report, what is the general tone before this all-important employment report in just under an hour?
It's really interesting because there was not much of a response with the Federal Reserve on Wednesday afternoon, which of course there was no change in interest rates. And this could be why we have virtually no volatility in the market. I would expect the response will be relatively muted to jobs data as well. Traders have almost become numb to what the Fed is doing or what data is telegraphing, and their attention is completely shifted to what President Trump and his administration are doing on a macro level and what specific sectors are being impacted. A tweet could change the course of your P&L in just seconds. This new environment is uncharted for global markets, and traders are figuring out what's the best way to maneuver around it.
Now, this week wraps up the busiest point of fourth quarter earnings season. What have been the standouts in earnings season?
Well, certainly the tech sector has been the rock star vertical between cyclicality and improving fundamentals. IBM and Intel have been the most notable in terms of turning around a mega cap legacy name. These giants have moved from hardware to cloud and services oriented companies, and the earnings and markets reaction have been favorable. You also have momentum names, what we call the FANG stocks, Facebook, Amazon, Netflix, Google. They're also reflecting that Amazon was a bit light on the numbers, down about 3% in the pre-market. I think we'll see a recovery there. At the end of the day, globally, we're an on-demand, services-oriented economy, and these stocks, like a Facebook, are reflecting that between performance and pricing.
Jill, just before I let you go, can you give us an outlook of what next week is going to be like there at the U.S. market?
Next week finishes the blitz of earnings that we have on the calendar. Will start to taper off towards the end of February. Fourth quarter earnings always seems to be a marathon versus when you look at second or third quarter earnings when they pack everything into 4 weeks. So I think really the focus is going to be on the end of earnings season. And of course, it's all eyes on Trump because we don't know day to day how his administration is going to alter policy. Like I said, on the overnight, we got the news this morning that he's looking to repeal Dodd-Frank. That could be a huge implication for the financial sector to the positive side because you're looking to remove a lot of regulations that have stymied their growth over the past 10 years in an effort to stave off another financial crisis. So the removal of Dodd-Frank is going to be something you want to pay attention to with the financial sector. Who knows next week what other policies are going to move other sectors. So that's really what traders will be looking at, earnings and what Trump is doing.
Right, thank you very much for your time, Jill. I know it's pretty cold there in New York, so you go grab a cup of coffee. I'll see you next week, of course, and enjoy your weekend. Right, we'll move over to Asia. Chinese shares were in the red after returning from a week-long holiday as a private Chinese manufacturing survey missed forecasts and China's central bank surprised the markets by raising its short-term lending rates. China's Shanghai Composite fell 0.59%, while the Shenzhen Composite was down 0.39%. Meanwhile, in Hong Kong, the Hang Seng Index was down 0.42% by mid-afternoon. Australia ASX 200 closed down 0.42%. Japan's Nikkei 225 index was flat at 18,918.2 after the Bank of Japan December meeting minutes showed that several policymakers said that they should not set a rigid range in trying to achieve its target of guiding its government bond yields to around 0%. In South Korea, the Kospi finished 0.1%. And here in Nigeria, now let's cross over to the fixed income market for the intraday trading. Ifeanyi Akweche, fixed income dealer with Wema Bank joins me now. Good afternoon, Ifeanyi. Thank you very much for joining us.
Yes, good afternoon.
Now, investors at both the Treasury bill and bond segment of the market were upbeat yesterday. Is that sentiment continuing today?
For the bond market, we've actually experienced some various performance. We're expecting some bond auction by 15th of this month. But for the T-bills market, it was quite bullish. If you can recall the PMA, the previous one.
We seem to have lost Ifeanyi there. In Zimbabwe, that country has started circulating a $5 bond note as President Robert Mugabe's government struggles with a cash crunch that has forced people to spend hours at banks queuing for money. The Southern African nation introduced a $2 note and $1 coin last November to ease the cash shortages. Despite warnings that it could eventually cause hyperinflation, the bond note currency is still trading at par with the US dollar. The Reserve Bank of Zimbabwe on Thursday released the purple's $5 note to banks. The Reserve Bank governor said $15 million of the new notes have been released, bringing the total amount of bond notes in circulation to $88 million. Zimbabwe abandoned its own hyperinflation-hit currency in 2009 in favor of the US dollar, but a widening trade deficit, lack of foreign investment, and a decline in remittances by Zimbabweans abroad have helped to fill foreign currency shortages. We'll take a quick break now, and when we return, of course, World Bank predicts that Congo's economy will average 5% growth this year. To stay with us.